Hello all and welcome back. Finally, some good news for Netflix. It actually has lost some subscribers as expected, but remember last quarter they were expecting to have lost way more, about 2 million, and actually they just lost a little bit less than a million, 970,000 subscribers is what they lost during the second quarter. So things went a little bit better than expected, actually, if not significantly better. And if we take a look at our stock news here, you will see most of the articles are talking about Netflix loses subscribers but stops the bleeding. Things like loses subscribers but not as many as predicted. And also, they're about to buy Happy Feet, an animation studio, Animal Logic here, as you'll see. It's probably going to add some titles like Happy Feet and things of that sort. Interesting, and it may add some nice extra to the portfolio of Netflix in terms of what they are displaying to people. And I myself, I own Netflix, even though I'm not an avid watcher or anything of that sort. I mostly prefer to actually spend my time on the markets, like studying the stocks and things of that sort. But Netflix is nice to have, and it does have some nice content for sure. I have talked about it in terms of investment though, and this is what we're examining in this video. This is what we're doing in this channel. We want to be making sure that we are buying it, potentially buying it at a fair valuation. This is all we care about. And you will see right now, yesterday actually it was up during the day about 5.6%, and then after hours almost 8%, added almost 8%. So overall an about 14% increase here, which is pretty nice to see for a Netflix holder actually, if they bought early. But we have examined Netflix earlier, and we did see that even though it has lost quite a lot of its price, really, that used to be about $700. Take a look at this, 70% loss, really. At some point, it was even more, I believe, and it has lost quite some. And it is, it is getting a little bit better lately. But is it still an interesting buy? Now, there is definitely a price for everything. I mean, overall, I'm not a big fan of these kinds of companies. Like media companies have a ton of amortization expected, huge capital expenditures, really. They were talking about adding some extra advertising here. We're going to examine all this in this video. I think this is very, very interesting. And we're going to decide whether it makes any sense to actually keep following on Netflix and potentially even buy at this price, which is going to be at about, what is it, like 217 bucks when the market opens. Potentially is what we're going to see. I believe we're probably going to reach 220 or so. So let's take a look at what happened during the earnings report. The results. EPS that was declared was 3.2 versus 2.94. That's a pretty significant bit here. Nice to see. Now, the revenue was a little bit lower, but not too low. Actually, it's like almost 8 billion versus 8.035. So it's about the same. It's about what was expected, a little bit less. But the very, very interesting thing is the guidance as well. The company, which currently has 220 million subscribers, that's obviously quite a lot, said it expects net adds to reach 1 million in the third quarter, reversing some of the losses pretty much during the first half of the year. So they're probably going to balance themselves out here. It's nice to see, especially when the price of the subscription has actually increased. So this means that they're going to be making more revenue, more than likely. And so, it's going to be a little bit of a picture of a company that's going to be steady for a little while, but it doesn't look like they are losing a lot of their subscribers really overall, I think. I mean, they will lose some, but the declines are do not seem to be that steep as some people would have expected, really. Now, analysts, you see here, had predicted that Netflix would guide for growth of around 1.8. So there is a little bit of a stalling there. There is a little bit of less growth, as you would expect. Again, this has a lot to do with the economy as well. What is happening right now? Netflix is a luxury, and a lot of people are not going to be selecting to add Netflix to their account, really, to their daily expenses for the most part, or monthly expenses. And so this is why they are going to be having less growth for sure. Maybe for a couple of years or so. We'll see how that works out for them. Now, let's take a little bit of a look at what is happening in terms of insiders and senators. I kind of want to take a peek using our tool here. You'll see that it's mostly awards here. So the company has been paying a lot with stock options, as you'll see, is what you're seeing here. A lot of these are just awards. So nothing weird happening here. Senator trades. You will see that senators have been lately selling Netflix here. They used to purchase quite some here. They sold a little bit, probably not everything, but they sold quite some. This person here sold quite some that they have been owning for a while now, it looks like. Okay, interesting to know at least. And let's take a little bit of a look now at our metrics. What is going on with the overall metrics of the company? So, in terms of the P ratio, it's sitting at 17.1 over here, and it's been going down. Look, take a look at this one. It used to be like 200 at some point, and it's going down and down and down and down, which is fantastic. This is exactly what you want to be seeing, right? This is amazing here. Now, the big problem with a company like Netflix, and I have talked about it in the past as well, is the free cash flow. It's tough for them to generate a cash flow that remains positive, because they have a lot of capital expenditures, and has a lot to do with new productions. They are spending a ton of money, and also they have insane depreciation and amortization expenses as well, which are, I guess, a little bit better for in terms of the free cash flow, because they're added back. But overall, they are expenses, and so they bring down the earnings that the company has. It is a significantly better picture in terms of the earnings of the company, of course, but not great in terms of the free cash flow. They at some point would need to reverse that. They did well during the pandemic years, but they seem to be going back into red territory here. Now, the free cash flow, again, it's negative. That's why you're getting a massively negative number here. So we don't have any, and quite significant total liabilities, it looks like. But the revenue growth has been increasing tremendously. This is a company that keeps growing in a fantastic way here, almost like like a linear growth here, pretty much, more exponential almost, practically speaking. But the 5-year the 5-year net income growth, take a look at this, it has been growing tremendously as well. It's the free cash flow that has been doing a little bit weirdly here all over the place for the most part, and total equity that has also been growing. Now, the debt that the company has is not too significant, but it's definitely something that we need to be taking a little bit of a look at, and at least be aware of it, because it's reaching about one-on-one base in terms of the equity. But it's better than what it used to be here, and that's obviously a very, very good picture to see. And the returns on equity are also pretty nice here, with a net income margin that is not negligible at all, as well, about 16 to 17% or so. So that's nice to see. Now, let's take a peek at the financial statements here. So the income statement from 11 billion revenue to 30 billion, great increase in terms of the revenue growth of the company. The net income from 500 million to 5 billion, another pretty nice increase in terms of the net income that the company generates. Now, the balance sheet, we can take a look at the total liabilities here of the company, 27, almost 28 billion, and the total equity 17.5 billion. That's generally speaking healthy stuff. I mean, the company is still having some positive total equity here. And when we took a look at the metrics section, I forgot to mention actually the outstanding shares, which have been increasing, but only slightly. And so for the most part, it's about the same number. So not much of a worry here, really. Now, let's take a little bit of a look at the cash flow statement as well. And you will see here that, yeah, the net income has been positive, and the operating cash flow has been a little bit all over the place, going back and forth because of a ton of depreciation amortization expenses that are added back, as we explained earlier. And also, the big thing, the other non-cash items that are expenses, that are cash expenses that have to be deducted from the cash flow statement. Now, as you can understand, the company has a ton of operating expenses creating all this content. And if you take it down to the cash flow that it generates, it comes back to negative territory, at least for the previous year. While it has had a positive year back in the COVID era, pretty much, the actual competition that they are facing makes it much tougher to stay relevant. And in order to achieve that, as you can understand, they have to be spending more and more money in production in order to be producing some quality content. And it's tough to have a positive free cash flow when you keep doing that. And you shouldn't also forget that they have tons of expenses because of amortization, because the content that the company creates at some point gets amortized. It loses its value over the years, is the thing. And that is an actual expense that needs to be pretty much deducted from the company's operations. And so all this point a picture that makes it a little bit tougher to invest in a company like Netflix. And this is why, unless I'm getting a very cheap value, a very deep discount, I wouldn't be entering Netflix anytime soon. Now you'll see here that the net cash from investing activities has been a little bit negative here, which is a good thing to see overall. They have been acquiring some stuff, investing in some investments. And in terms of financing, you will also see that they have been repaying some debt and repurchasing just a little bit of common stock here. They do have some extra cash in their reserves as well. And the last thing that I want to do before pretty much finalizing the video is use our projections tool and see what kind of price it makes sense to pay for the company. Remember that you can use this tool on your own if you are become a Patreon. You can find a link in the description box below this video if you are interested. And the revenue that the company has been enjoying has been pretty much amazing in the previous years. Now, for the next 5 years of our DCF model, which is what it works with, we won't go that high. We can't go that high. Yet we will go with something that makes some sense, I believe. Something like maybe 8, 10 and 12% is probably fair. Now the company could be achieving even less potentially, if we enter sort of like a recessionary environment. But overall, an 8, 10 and 12% revenue growth appears to be probably likely for a company of this sort. Again, you can use your own projections if you get access to the tool, and you can go with all sorts of different types of revenue growth that you want to add here and check for. Now, the net income margin is about 10 to 12%, 17 last year. It has been better. I'm gonna go somewhere in between. I'm going to go 10, 15 and 18. Actually 17, because 17 seems to be what they did last year. And free cash flow margin is where things are not that great over here, because the company, remember, has been losing a ton of free cash flow. So we're gonna go with something that overall makes a ton of sense in terms of free cash flow conversion to net income. And this is about 90%, 100% and 110 in between these values. And an annual return of 13% is what we want to be enjoying out of our investment. Let's hit calculate. What are we getting? And now you will see that our medium estimates are already there. They are sitting at 203. If we go with a 10% revenue growth, 15% net income margin and 100% free cash flow margin, which is basically 15% of, it's 100% of the net income, which is 15% pretty much when comparing to the revenue. And so I believe that I would probably want to be somewhere close to this value, frankly. I probably would want to be near 110. I would have thought 203. We seem to be there, although the company is going higher after today. Again, this is the after hours, where it's going to be about 220. So this is gonna be red again. But it has gotten significantly cheaper, as you can understand, from the 700 that it used to be some time ago. It's not there yet for me. I would want to get it at a lower price if possible. So it's not a buy for me right now, even though the medium is green here. This is a much riskier company. Now, if I had the same picture, which it is about the same picture, actually it's better, but it's a similar idea, it's a similar concept. It's sort of like red for Google, for example, on your low estimates. But it's a much different picture, a much different company in terms of how they have been growing, in terms of the challenges that they're facing, in terms of their margins, in terms of the free cash flow, more importantly. A much more profitable company is Google than Netflix, and so I am willing to pay a more expensive price, which I'm not really willing to do for a company like Netflix here. And I think that I would have to stick to a valuation close to 100 to 110, maybe 120 if I'm feeling frisky here, but I probably wouldn't go more than this one, even though they seem to be doing a little bit better than what they used to do in the previous quarters, at least the last couple of ones, especially the last one, which was a disaster. Thanks for watching the video, guys. I hope you enjoyed this analysis. Remember to leave a like, that helps a ton, and subscribe if you're not a subscriber already. There will be tons of more videos coming your way, really, in the next maybe 2 or 3 days, because we're having a ton of earnings reports. Very interesting companies that I really want to talk about, and they could be adding some potential value to a lot of portfolios, really. So we're gonna be talking about those in the next couple of days or so. Again, thanks for watching, and I'll see you soon. Bye bye.